Warren Buffett, not a bad investor, has said that you make money by being brave when others are afraid, and afraid when others are brave. Or conversely, you make money buying straw hats in winter. So the circumstance around my attraction to precious metals, we've gone over before. Gold, as an example, or the precious metal space, tends to do well when people are concerned about the maintenance of the purchasing power of their savings in conventional instruments. Nothing like negative real interest rates to make somebody feel concerned. But this change in attitude takes time. And most speculators in particular aren't willing to assign the time that they need for their investments to mature. Silver traditionally has acted like gold on steroids. It moves in the later part of a precious metals bull market. When you're in a precious metals malaise, it declines faster than the gold price does. But when precious metals prices turn around, they perform better. Perhaps because I've right-sized my investments, which is to say I don't have my whole net worth in penny silver stocks. The fact that they're declining in value while the malaise period is running past us is very attractive to me. What's more attractive to me right now is across the whole real micro cap space, the sub $100 million market cap space, there's no liquidity in the sector. Companies that played chicken with capital markets, didn't raise money when they could, are now having to raise money. And they're having to raise money in a circumstance where money isn't broadly available, which means that the terms that I'm being offered, not just in the silver space, but really across the micro cap space, are the best that I've seen in 5 years. Will I be able to sell those tomorrow? Will I be able to blow out my position by the next long weekend? Do I care? No, not at all.
When we first started talking to you a year ago, when we started Wall Street Silver, let's call it early March, April 2021, uranium was hated at the time.
Right.
It was hated. And I went back and looked at our early videos with you when we first interviewed you, and you were talking up uranium before uranium got hot. And you were talking about, you were reviewing every single uranium exploration and junior producing company out there, and you were buying them hand over fist. You bought them when everyone hated them. And now uranium's trendy, everyone's talking about it. Japan's starting up all their nuclear power plants again, taking supply off the table. Sprott Uranium Trust is buying, millions of pounds of uranium and taking it off the market. So I sort of bring up the uranium history of you were doing that, buying them when everyone hated them.
Right.
And now uranium's, at double the price, and it's still going, and you're not selling uranium yet, or your uranium stocks. So should silver and gold investors be taking that longer term view? I guess that's the analogy I'm trying to make.
I think that the broad part of the analogy is accurate, which is to say you buy a sector, if you like the sector, when it's out of favor.
Right.
You don't wait for the psychological reinforcement of rising prices, because the rising prices reduces your yield. Listen, if nothing has changed around a company but the price is doubled, it's arithmetically half as attractive. If nothing has changed around a company and the company falls by half, it's arithmetically twice as attractive. But most people don't make the connection between price and value. Most people pay real attention to the price with having no knowledge of value.
No.
The price is a floating abstraction if you don't have any sense of what the value is. And most people would rather be comfortable than become rich. I'm already comfortable.
You're already rich.
I don't speculate. I don't speculate to be comfortable.
Yeah.
I go out and, sit on my deck in the sunshine and drink a beer with my wife to be comfortable. I speculate for very different reasons. So I need to say, twice before in my life, no, 3 times before in my life, I've been a tremendous beneficiary of the run-up in fairly obscure silver stocks. It's happened to me 3 times now. At age 69, I'd like it to happen one more time. Will it happen? I honestly don't know, but I think it's a probability, not a possibility. And I get admission to this potential party, whenever it might occur, at prices that are lower in the silver space than I would have dreamed of enjoying a scant 3 years ago. So, for me, this is just sort of a dream come true. This is the opportunity to have a sort of a swan song after a very lovely career to an absolutely spectacular party. Or let's put differently, as a younger person, this is the ability to go into a really target-rich nightclub for no cover charge.
That's nice.
How can you resist this?
You're seeing a lot of attractive girls in the nightclub still.
Well, I'm not allowed to say that anymore. ESG gets in the way. Let's just say targets.
Targets of opportunity. They're out there. You just gotta, be patient and hunt for them. And you were telling me, if you're looking at private placements, and that's what's worth investing in right now, if you're in this sector, you're looking for warrants on a private placement that go out more, if a half warrant or a full warrant that goes out 2 or 3 or even 5 years. That's what you're looking for. That's where the terms where you think it starts looking attractive.
Yeah, absolutely. I mean, you really shouldn't do a private placement if you don't get a warrant. You get restricted securities, and you're providing capital and liquidity to people who have free trading securities. So in a sense, without a warrant, you're subsidizing the existing shareholder. And they probably are not sending you a Christmas card or a birthday card for that. The reason why you contribute to a company with a restricted security is that you should get the ability to get some extra juice out of your investment. And that juice comes in the form of a warrant. Now, many companies, many issuers will tell you that a warrant is dilution. But for some reason, their directors' options aren't. The difference between a warrant and an option is merely who gets it. When I have these discussions with company managements, they often say, well, warrants aren't the same as options. I work at the company 5 days a week. And I say, thank you for pointing that out. My money works at the company 7 days a week. So theoretically, I should get 7/12 of the benefit if you add 7 and 5. So I like, when I do private placements, to have a warrant package that looks very much like the option package, that has the same duration, most often 5 years, that has the same strike price and terms. And I like to get a pledge from the company that they won't reduce the exercise price of their stock options if they don't reduce the exercise price of my warrants. In other words, I want to be treated pari passu with managers.